Hi all, I am Keith Collins, a modern mortgage advisor using a simple technology to help guide our customers in what is traditionally a pretty complicated process. Check it out. The lowest interest rate is not always the lowest cost, and I believe in 2021 customers may not be getting the wrong loan, but they might not be getting the right one. So how do we identify which option is the right option over time? We have to have a smart, effective, and efficient technology that stack ranks loan options against each other and then projects them over time, right? So one customer might be in a home for 3 years, the other customer might be in a home for 15 years. The same mortgage program probably won't be the right mortgage program for both of those people because they're going to be in the home for longer. So now we're using this technology to help combat a problem that most of us face, two problems most of us face in this tight inventory market. Problem number one, help guide and consult our customers in this crazy real estate market when we're asking them to write some pretty aggressive offers, maybe ones without a loan contingency and maybe ones without appraisal contingency. But we know as modern real estate professionals in this tight inventory market, these are the things that we have to do to win transactions. But these are also the things that scare our buyers, especially our first-time home buyers. So we've got to have really smart ways to be able to show them that, hey, we've got solutions in case the property doesn't appraise. The second thing is alleviating the concerns of a low appraisal. One of the questions that I get all the time from a listing agent when I'm calling to advocate for our buyers behind an offer is, do the buyers have the funds to pay the difference if the property doesn't appraise? And my answer most often is the borrowers don't have to. And what's cool is that stumps them because there's this misconception that you have to come in with the difference if the property doesn't appraise. And that's just not accurate. Let me show you how. All right, so here's what I got. It's a recent transaction that we did for a customer where we're having the conversation ahead of time. They're writing a $500,000 offer, but we're concerned that maybe it's not going to appraise. We're thinking it might appraise for $490 or $480, but not less than $470. The client's cool with this, but they want to make sure that the payment doesn't get out of line for them and their cash to close is within a number that they can handle. So the column on the left, you'll notice we've got some stuff highlighted here. We get a $500,000 purchase, a $500,000 value, putting 10% down. We got a payment of $26.35 a month. The cash to close, which includes down payment and closing costs, is about $65,100. And this is where it gets interesting. Cruise over to the right here. We've got it appraises at $490, but the seller doesn't adjust price. So we're still at the $500,000 price. The rate does move up a little bit, and that's where we're using these numbers in mortgage insurance to get creative. You could use a single premium mortgage insurance program, but what we're doing is we're just adjusting the rate up a little bit and using that difference to buy out the mortgage insurance. The payment, $26.66 a month, which is really only $30 more per month. So it appraised for $10,000 less, but the payment only goes up $30. And here's where the magic is. Check out that cash to close, $65,700. So we really are only having a $600 increase in out-of-pocket expenses when the property appraises for $10,000 less. Let's scroll over to the $480. So check out a $480 value, $500,000 contract price, mortgage payment stays the same at $26.66, which is beautiful. I'm a math nerd. This stuff makes me crazy. I love it. $26.66 for a payment. That's only a $30 increase. The cash to close is the exact same. So check that out. The home appraised for $20,000 less. The listing agent asked, does the borrower have the funds to pay the difference if the property doesn't appraise? My answer is they don't have to, because it's only $600 more if it appraises for less than for $20,000 less. And then the big one here is the $470. So we're just suggesting maybe it's going to appraise for $470 instead of $500. This is where we see a little bit of number change, but the payment's $26.50 and the cash out of pocket is $69,000 instead of $65,000. So we got about a $4,000 increase in out of pocket, but it appraised for $30,000 less. This is where we create an environment where we can get creative and have confident conversations with our customers when we're having to write aggressive offers and they're concerned that maybe the home doesn't appraise. We can show them that it's okay. If you love the home and still want to buy the home, even if it doesn't appraise for the contract price, your numbers aren't going to change and you're still going to be able to do it, and your deposit won't be at risk. So we really believe that all lenders should be doing this. I mean, the lender is the number one partner that I think a real estate agent has, and we're the number one conversion partner. But conversion doesn't stop at application. If we don't close a home loan, what's the point? And if we can't get into contract, there's no way we're closing a home loan. So the loan officer's got to come alongside our real estate partners and advocate for our buyers on behalf of the buyers with the listing agents and provide creative scenarios using programs and tools like this so that we can help the borrowers be confident in this crazy real estate market. So this was fun. And Todd, Dave, I really want to thank you so much for the opportunity to speak here in the Modern Real Estate Summit. It's been my pleasure, and I hope this information was super useful. You guys have an amazing day, and thank you all so much.